In the previous lecture, we described the elements of options and the nature of their payoffs and profits. In this session, we'll discuss how you can use them as part of an investment strategy. In particular, we'll examine two ways you can use them. You can use them to speculate, exploiting the fact that options are like highly levered positions in the underlying asset. We'll also examine how you can use options to control risk or hedge. Because speculation can be very risky, we're going to spend most of our time on hedging. But let's start with speculation. First, what do I mean by speculation? What I have in mind is that a person is speculating when he or she is betting on a security moving in a particular direction. For example, suppose you're reading the paper and you find out that the fees for the disposal of used oil from deep fryers is likely to fall in the near future. If so, then the values of U.S. fast food companies, say for example McDonald's, they're likely to rise, reflecting higher future profits. If you currently own stock in McDonald's, you'd be happy. But what if you didn't own any stock in McDonald's? Well, you could do two things. You could either go buy some stock, or you could speculate with options. Let's compare these two strategies through a specific example. Let's say you have $1,000 to spend speculating. Let's say that the current price of McDonald's is $100. So with your $1,000, you can buy 10 shares. If after 3 months it's clear that the fee will fall, the McDonald's price, say, rises to $105. So your 10 shares will be worth 10 times 105, or $1,050. Your 3-month return is going to be R, such that 1,000 equals 1,050 divided by 1 plus R. That is a return of 50 over 1,000, or 5%. Not bad. If you could get 5% return every 3 months, after compounding, that's 21% per year. Okay, so instead, if you choose to speculate with options, what kind of options could you use? And how many of these options could you get with $1,000? All right, so what you want is you want an option that pays off when the price of the underlying rises. So you're going to want a call option. With call options, if the price of McDonald's rises above the strike price at expiration, then you can call in McDonald's stock for that strike price. Or, according to cash settlement, you could also just get the difference between the price of McDonald's at expiration and that strike price. Thus, if prices rise, that's good for a call. With a put option, if the price of McDonald's rises above the strike price at expiration, then your put is worthless. So speculation on rising prices, puts are bad. So you want to buy calls. Now, you actually have many calls that you could buy. For example, there are going to be calls with a strike price around $90. There are going to be calls with a strike price around $100. And calls with a strike price at, say, $110. Let's say the calls with a strike price of $90 cost $12. And the calls with a strike price at $100 cost $1. And the calls with a strike price at $110, let's say they cost 50 cents. Let's consider the call with a strike at 100. That is the at-the-money option. It seems better than the other two. So why is that? The option with the strike at 90 is in the money now, but it's kind of expensive. It's expensive because if you could exercise it now, it would pay off, $10. But if the price of McDonald's doesn't go up by expiration, you would be out $2. The one with a strike price at 110 is out of the money. It's cheap, but the price will have to climb a lot before it gets into the money at expiration. The at-the-money call is a good compromise on cost and the likelihood of it being in the money at expiration. So with your $1,000, you can buy 1,000 at-the-money calls. By the way, the standardized contracts for cash settlement are based on 100 shares. Thus, when you buy one option contract, you're really buying 100 individual options on one share. Although the contracts are for 100 shares, the prices are always quoted on a per-share basis. So when you buy 1,000 calls, you're actually buying 10 call option contracts. Okay, so let's see what you get by buying 1,000 calls. When the price of McDonald's rises to 105 in 3 months, you will exercise your calls and get, $5 per call. All right, so now what's your return? Once you subtract the $1 you paid to get the call, you're going to have $4 in profit per call. On 1,000 calls, that's $4,000. That's a net gain on your initial investment of $1,000. It's equal to $4,000. That's a 400% return over 3 months. So the options are much better than just buying the stock. By speculating in the stock, you make 5% on your money. By speculating with the options, you make 400%. But what happens if it turns out that the used oil fee is not lowered? Well, that would be bad news for McDonald's, and the stock price would probably drop, say to 98. If you purchased 10 shares of McDonald's, at the end of 3 months, you would still have the 10 shares. Each would be worth 98 for a total of $980. So you lost 20 out of your initial investment of 1,000. That's a 2% loss. So that's not good, but it's not really all that bad either. But what happens if you had speculated with those calls? If the price of McDonald's turns out to be 98 at expiration, you will not exercise your calls. They are out of the money. They're worthless. In this case, you get nothing. You have spent $1,000 to buy 1,000 calls, and you have nothing left. Your return is minus 100%. That's not bad. That's really, really, really bad. So by speculating with options, you can amplify your gains and your losses too. If you really know which way the price is going to go for the underlying, then you may want to use options. If you think prices are going to rise, buy a call. If you think prices are going to fall, then what you want to do is you want to either short or you want to buy a put. By the way, the analysis of these cases is exactly analogous to the buy or the buy a call analysis that we just conducted with the McDonald's example. Now, speculating with options is very similar to speculating with borrowed money or leverage. To see this, consider speculation in which you again only have $1,000 but borrow in order to leverage your returns. If we borrowed $79,000, we can combine that with our own $1,000 and get what? 800 shares of McDonald's. Now that's a leverage ratio of 79 to 1. Just to keep things simple, let's say that the interest on this loan is 0. The lender has no idea that you're speculating. If the price of McDonald's rises to 105 per share as predicted, then you're going to get what? You're going to get 105 times 800. You're going to get $84,000. And then once you pay back the $79,000 you borrowed, you're going to have $5,000. Since you put up only $1,000 and you get $5,000, then your return is again 400%, the same as with the call option. So the call option is like being levered, 79 to 1. What happens if the price falls to 98? In that case, your 800 shares are now worth only $78,400. And after you pay back as much as you can, you have nothing left. Your $1,000 is gone. Again, a minus 100% return. Buying a call is very similar to an extremely levered position in the underlying. Your returns are very sensitive to the return on that underlying. And by the way, the same is true of a purchase of a put. Okay, now you can also speculate by selling puts and calls. Rather than speculate that the price will rise by buying a call or speculate the price will fall by buying a put, you might want to sell a call to speculate that the price will stand still or fall, or you might want to sell a put to speculate that the price will stand still or rise. With this kind of speculation, you are just selling the options to get the money, betting that the prices won't move in such a direction that the buyer will want to exercise them. When AIG sold credit default swaps, they were selling put options on bonds. One view is that they just wanted to make the money by selling the protection. They never thought that the puts would actually be exercised. And they were wrong, and they lost a tremendous amount. There's one more type of speculative strategy I want to discuss. This kind of speculative strategy is where you bet on volatility. So consider the following strategy, where you combine puts and calls. Buy a call with a strike of X, say, for C dollars. Buy a put with a strike of X, the same X, for P dollars. This strategy is called a straddle, by the way. What will you get as a function of the price of the underlying at expiration? To figure that out, I want you to sort of draw a profit diagram for each position separately. Recall that the profit diagram plots the profit on the vertical axis as a function of the price of the underlying at expiration on the horizontal axis. Once you plot the profit for each, then I want you to do this. I want you to add them up vertically. The profit on the call will be a flat line from 0 to whatever the strike price is at X. Since you just paid C dollars to get it, the flat line is drawn at a height of negative C on the vertical axis. Then, for every dollar the price at expiration is above the strike, the profit will rise by $1. Thus, at the point on the profit line at the strike price, the profit line slopes up 1 for every one above the strike. So it's a hockey stick with its handle up in the air to the right. Okay, let's think about the put. For the put, it's a hockey stick as well, but this time the handle is up in the air to the left. The level of the flat part is at what? Negative P dollars. Okay, next thing we need to do is we need to add them all up. All right, so the best way to do this is to simply start at a strike price and then add the two levels of the two profits. If the price of the underlying at expiration is the strike price, X, then you will not exercise either the put or the call, and your profit will be what? It's going to be the cost associated with the put and the call. You're going to have a negative profit in this case, so the profit is going to be negative of the combination of the price of the call plus the price of the put. Now, what if the price is $1 lower than the strike price? Then the call will be worth what it was at X, but the put will be worth 1 more than it was at X. Thus, the profit line rises 1 from what it was at X. For every dollar the price falls below the strike, the profit line rises $1. Next, consider what the profit line looks like when the prices of the underlying is actually above the strike price. At X, again, it's negative what? The combination of C and P. As we move to the right, the call starts to pay off $1 for every $1 in the underlying. The put is worthless now, so combined, for every dollar above X, the profit line is going to rise $1, pulled up by the profits on the call. What you get is a combined profit line that has a V shape, with the bottom of the V at the profit of what? Negative C plus P. The cost of the put and the call. Note that if the price of the underlying ends up far away from X, then only then will you make a positive profit. But if the price of the underlying ends up close to where the strike price is, you're going to lose. Typically, speculators would do this strategy with the at-the-money puts and calls if they believe that volatility is going to be very high. This strategy is designed to speculate on lots of volatility in that underlying. Okay, so with the previously discussed just call or just put strategies, we were speculating that the price would move in one direction for calls up and for puts down. The straddle strategy that we just talked about is when you have really no idea which things are going to move. All you think is that they're going to move a lot. But you should realize that, as we'll see in the next lecture, the prices of both puts and calls increase with the market's belief about volatility. If you think volatility is high, the market may also think that it's high. And if the prices of puts and calls rise, then the bottom of the B is going to fall. And the distance the price has to move away from the strike price has to be even bigger in order for your straddle strategy to become profitable. Another speculative strategy is called a butterfly spread. This strategy has you combine long and short positions in calls with different strike prices. There are also put versions. So let's consider an example. Let there be 3 different strikes, a strike at 90, 100, and 110. Consider the following strategy. Buy a call with a strike at 90, buy a call with a strike at 110. So buy 2 calls, one with a low strike price, the other one with a really high strike price. And then what I want you to do is I want you to sell or write 2 calls with the middle strike price at X equals 100. See if you can figure out what that looks like on a profit diagram. Also, what do you think that you're speculating on when you adopt this strategy? As a hint, it's sort of the opposite of a straddle. Okay, so we've been looking at a few speculative strategies. Let's consider the second type of strategy that you can implement with options. You can hedge with an option. Okay, so now what do I mean by hedge? A hedge is something you do to soften the blow of something bad. This is in contrast to speculation, which amplifies your returns. When you use options to hedge, you must already have some exposure to some risks that affect the value of the option's underlying security. A very common and effective hedging strategy is called the protective put strategy. The best way to think about the protective put strategy is that it is a side bet that pays off when things go bad for you. I grew up in Los Angeles, and because of that, I'm a huge fan of the Los Angeles Lakers basketball team. I was a huge fan, by the way, of the so-called Showtime fast break Lakers that had Magic Johnson and Kareem Abdul-Jabbar. Now that I live in the Eastern time zone, every year at playoff time, I literally and figuratively lose sleep over the Lakers. I literally lose sleep because their games are on late in the East. And I figuratively lose sleep because, while they fairly often get into the playoffs and win, they also often lose. And I'm heartbroken. Now, once I learned about hedging, though, I made a bet with a friend against the Lakers in the playoffs. And when they lost, I was heartbroken, but I would console myself with a fabulous steak dinner with the winnings from my side bet. I hedged. And when the Lakers won, I was happy they won, but I had to give someone else a steak dinner. I was hedged. The side bet dampened my overall happiness. I could have used options actually to much better effect. If my bets were put options, I could have gotten a steak dinner when they lost and not had to give someone else a steak dinner when they won. I would be consoled when they lost, but I would get all of the upside when they won. Okay, so let's return to our McDonald's example from earlier. But now let's say you are the owner of a McDonald's franchise. Thus you face some risk associated with changes in, say, the used oil fees. If fees rise, the profitability of your franchise will fall, along with McDonald's stock. If fees fall, your profitability and the price of McDonald's will rise. So in this case, you have an underlying exposure to risk, the risk that the oil fees will change. Also, the McDonald's Corporation has an exposure also to these oil fees. Thus, you both have an exposure to the same risk. You cannot buy options written on your franchise, but you can buy options on McDonald's. Let's see how you can use this to your advantage. Let's say you've done some analysis and have determined that for every dollar increase in the fee, the value of your franchise will drop $150,000. This is just the present value of the extra cost that you faced. Similarly, for every dollar drop in the fee, your franchise will going to increase $150,000. Also, when the fee changes by 1, the price of McDonald's common stock is expected to change by $5 per share. In the parlance of hedging, we would say that your hedge ratio is $150,000 to $5, or $30,000 to $1. That is, for every $1 increase in McDonald's stock, there's an increase in your franchise value of $30,000. So how can you protect yourself against a change in the used oil fee? By using a protective put. With this strategy, you'll buy puts written on McDonald's common stock to go with what you have in your exposure in your McDonald's franchise. If the fee is increased, the value of your franchise falls, but your put options pay off big as the value of McDonald's stock will fall below the strike price of those puts. If the fee is reduced, the value of your franchise will rise, and you won't need the protection from the put, which you let expire out of the money. That is, the protective put acts as insurance. In fact, it's just like insurance against an accident, where the accident in this case is that used oil fees are raised and your franchise value falls, i.e. it crashes. As with insurance, the policy only pays when you have an accident. And if you don't have an accident, you still have to pay the premium. Thus, with a protective put, the premium is the price of the put. If there is no accident and the fee stays the same or falls, then you're out the cost of the put option or the premium. But if there is an accident and the fees rise, your franchise is damaged, but the profit from the put offsets that damage. Now, how many puts should you buy in this case? Since your hedge ratio is 30,000 to 1, you want to make $30,000 every time the value of McDonald's stock falls by $1. Let's consider using, say, an at-the-money put option. Recall that the current price of McDonald's is $100, so let's consider a put with a strike of 100. With this strike, for every dollar the price falls from 100, the put payoff will, increase by $1 at expiration. Let's call the change in the payoff of the option per $1 change in the underlying that option's delta. In this case, the put delta is -1, since as the price falls, the put payoff goes up. It's a negative relationship. How many puts should you buy? Since your hedge ratio is 30,000 to 1, you want to make $30,000 every time the McDonald's stock price falls by 1. Since the magnitude of the put delta is 1, you want to buy 30,000 divided by 1 puts, or 300 100-share put contracts. Note that if the delta had been 0.5 for every $1 drop of McDonald's stock, then the put payoff would only go up by 50 cents. In that case, you would need 30,000 divided by 0.5, or you'd need 60,000 puts to hedge your franchise exposure to these oil fees. By the way, we will see why a delta may be less than 1 a little bit later. But the magnitude here is 1, okay? So let's go back to a magnitude of the delta being 1. So let's go back to the example. If the fee goes up $1 and the price of McDonald's falls, $5 to 95, you will make $5 at expiration on each one of your puts for a total of what? You got 30,000 contracts, 30,000 times 5, that's $150,000. That gain of $150,000 exactly offsets your loss in the franchise value of $150,000 associated with that increase in the used oil fee. Note that the insurance, in this case, cost you $30,000. And if the fee had stayed the same or dropped, you would still have had to pay the $30,000 for what turns out to be worthless puts. But this is always true for insurance. You have to pay your premium whether or not you have an accident. Okay, so in the previous example, we waited until expiration to exercise the put. But by the way, you don't have to actually wait. In that case, what you can do is you just have to use the delta that you get by considering what happens to the price change in the put. So with this approach, what you do is you take a position in an option such that when the bad thing happens to you, the price of the option rises. And when a good thing happens to you, then the price of the option is going to fall. The delta is the amount the option price changes prior to expiration, given a change in the value of the underlying. The magnitude of option deltas are always less than 1 prior to expiration. I'll make this much more precise when we develop the pricing models for options in the next lecture. The intuition, however, is as follows. The value of the option is related to what? The likelihood that it will be in the money at expiration, and conditional on it being in the money, how far it's going to be in the money at expiration. Thus, for a call, as the value of the underlying rises, both the likelihood it will be in the money and the amount that it is likely to be in the money if it's in the money increases. This is true because it is either closer to being at the money or it's farther in the money already. As a result, the value of the call will rise as the underlying rises. Conversely, as the value of the underlying falls, the value of the call is going to fall. A similar argument can be made for puts. For a put, as the value of the underlying rises, both the likelihood it will be in the money and the amount that it will be in the money actually decreases. It's either farther away from being in the money or it's less in the money already. This results in the value of the put, falling as the underlying increases. Conversely, if the value of the underlying falls, the value of the put is going to rise. But how much does the value of the option change given a change of the value of the underlying? Since it's not a sure thing that it's going to be in the money at expiration, the option price does not change dollar for dollar with the underlying value. So what that means is what? The delta is not equal to 1. The magnitude of the delta, however, gets closer to 1 the closer it is to being in the money, and the farther it is already in the money. The magnitude of the delta is smaller the farther it is out of the money. In the next lecture on pricing, we will see how you can get an explicit expression for the delta. Once you have the delta, you can use that as we did use the delta in the McDonald's franchise example of hedging before. In this lecture, we've seen how we can use options to speculate. We have seen how you can also make bets on the direction of movements of the underlying securities. But we've also seen how you can make bets on what? Underlying volatility. By the way, I recommend that you're very careful with this speculation because speculating can be very risky. What you need to do when you're thinking about speculating is figure out why you think that the price is going to go in a particular direction or not. And if you're speculating on volatility, why you think volatility is going to be really large. Now, one of the things that you have to realize, right, is that the prices reflect the market's view on this. And so if you think, that the volatility is going to be really large, you need to take into consideration the fact that that might already be reflected in the prices. So you need to ask yourself, if you think that the volatility is going to be large, what makes you think that the market also doesn't think that volatility is going to be very large too? If you can give yourself a good reason why you would have superior information relative to the information in the market, then yes, you can speculate on volatility using the strategy we talked about. But if you cannot come up with a really good reason, then I don't recommend doing it at all. We've also seen that you can use options to hedge. We've seen that there are very important variables to figure out in order to come up with the right hedge strategy. What you need to figure out is what the hedge ratio is, and you also need to figure out what the option delta is. So the option delta tells you how much the option value changes when there's a change in the underlying. This is telling you something about how sensitive the option value is to the underlying exposure that you have with that option. If you have a hedge ratio, the hedge ratio tells you how much of the thing that you have changes with the underlying. Using both the hedge ratio as well as the option delta, you can put together a strategy that allows you to compensate yourself when a bad thing occurs, but not give away any of the upside when good news occurs. In the next lecture, we will discuss how to price options. This lecture will allow you to see the cost of insurance and see if it's too expensive. To give you a little insight into this, what we're going to do is we're actually going to price the options according to a replicating portfolio strategy. We're going to try to come up with a way in which we can replicate the payoffs on options using the underlying securities, the underlying security, and also risk-free borrowing and lending. By doing this strategy, what we're able to do is come up with a price for the option. But recognize with this strategy, the option is essentially completely redundant to something that you can do for yourself. So you either want to get the insurance through the option, or you can actually build the replicating strategy for yourself. The price of the option that we get in the next lecture is something that is based upon this no arbitrage argument, or based upon the notion that these two things will give you essentially the same payoffs. We'll see how to do this in the next lecture.